This video will help you understand whether you should roll your UTMA or UGMA account for your kiddo into a 529 plan. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. One strategy that's very popular for the age demographic of clients I work with is whether or not they should move their child or grandchild's UTMA or UGMA account into a 529 plan. Now, this might look like opening up a 529 plan and moving the UTMA into there, or between the UTMA and 529 plan that already exists, consolidating that UTMA into that existing 529. So in today's video, we'll touch on the logistics of how to make that happen, as well as some pros and cons to be aware of if you want to go down this route. So let's jump in. So most often, the strategy of moving a UTMA into a 529 plan is actually foreign to most clients, but you are legally permitted to move UTMA money into a 529. Now, there's a number of different reasons why this might resonate with a particular client. Perhaps the family's thinking a little bit more seriously about the expenses that some extra or secondary education might cost, and so they want to maximize what benefits they have towards those goals. Perhaps they don't like the idea of their child or grandchild getting access to all this money that's in this account when they turn 18 or 21. Or most commonly for my higher income clients, they're getting tired of paying the capital gain and interest income taxes that are associated with a UTMA account that they won't have if the money is in a 529. Perhaps generation 1 or 2 is focused on building some extra generational wealth for generation 2 or 3, meaning you can cascade down 529 beneficiaries over time. Or perhaps generation 1 or 2 are trying to really maximize their gifting strategies, and they realize that there's some extra benefits to gifting into a 529 plan. Now, I'm sure there's more reasons than just that as to why clients would want to do this, but these are just the most popular ones that come to mind. That being said, if you're unfamiliar with how each one of those are a feature to moving UTMA to 529 money, then let me quickly explain the differences between UTMAs and 529 plans. And if you're already familiar with those two buckets, you can skip ahead, I'll timestamp below. So first, touching on UTMA or UGMA accounts, sometimes just colloquially referred to as UTMA or UGMA, although I don't say that, I just call them UTMAs. It's all the exact same stuff. It stands for Uniform Transfer to Minors Act or a Uniform Gift to Minors Act. I'll link above to my previous explainer video on how UTMAs are taxed and some of the nuances there. It's good information to know about if you have one of these accounts or you're thinking about setting one up. At the end of the day though, this is an account that's open for a minor because legally minors cannot open and control their own investment accounts. You open up this investment account on behalf of the minor and you name yourself or another adult as the custodian of that account. And that's because minors aren't legally permitted to control their own finances. An adult has to be signed as the custodian over that account. And that's the person who makes all the investment decisions or where this money goes. Most often that's a parent or grandparent. It's also a great repository where if you give a child money and where's that money supposed to go, oftentimes the parents can just deposit that check into a UTMA account and that's for their benefit. And that way you're not necessarily just gifting the parents a bunch of money if you really want it to go towards the kiddos. And like any other brokerage investment account, you could invest this money in stocks, bonds, mutual funds, index funds, whatever. Also like a brokerage account, however, any capital gains or interest income that's generated within the portfolio of this UTMA account will result in capital gains and interest income taxes. And that'll all be outlined in the annual 1099 that gets sent to you from this investment account. Now, there's a very small threshold of capital gains and interest that if it's produced inside of a UTMA account, you do not need to report this on any sort of tax return. However, if the interest in capital gains is high enough, then you will have to report this 1099 on the parent's tax return, and they'll pay the subsequent 10% taxes on behalf of the child on their return. Theoretically, you could file a child tax return all in of its own, but that probably wouldn't make the most sense. It'd probably be a lot of extra work and maybe extra fees for tax prep. Now, if the capital gains and interest are high enough, you might actually end up needing to file a child's tax return in and of itself. And so there's some extra hurdles and logistics that come into these UTMAs if they get too large and if they generate too much capital gains and interest. You might see somewhere online that UTMAs grow tax-free. It's total BS, it's not true. There's a certain threshold where technically you don't pay taxes on the growth, but if you've done a great job saving into this account, eventually you'll pay capital gains and interest income tax. And of course, once the child gets control of this money when they reach the age of majority in that state, then they will pay income and interest taxes on any sort of growth that occurs within this account, because they're going to keep getting a 1099 every year, and now there's no more exemption level because they're no longer considered a minor. I'll link below to a map that breaks down which states label which age of majority for UTMA accounts, so you know, hey, if I have one in this state, here's when my child will have ownership over this account. It's different for each state. And this is one of the biggest concerns with parents and grandparents who set up UTMAs, is knowing that I sure hope by 1821, my kiddo is wise enough financially not to make poor decisions with the money. Specifically as it pertains to FAFSA, when applying for student aid, a UTMA will be considered an asset of the child, and that'll oftentimes hurt them by way of qualifying for financial aid. 529 plans, on the other hand, are not considered assets of the child, even if they're named as the beneficiary over that account. Usually the way a 529 is structured is the parent or grandparent is the owner of the account, and the beneficiary would be the child, but you can change the beneficiary of a 529 at any point. And since usually the parent or grandparent are listed as the owner of the account, then technically it's their money, not the kiddo's money. Therefore, on FAFSA, you're not hindered from a financial aid standpoint if a child is named as a beneficiary. As such, since the parents and grandparents are probably going to be the owners of these accounts and not the kiddos, although you could name the kiddo as the owner, then the kiddo does not get unfettered access when they reach the age of majority. It's technically still the parent and grandparents' money, assuming those are the owners of the accounts, and they get to control what happens to this money throughout their lifetime. Where the 529 plan really shines, however, is in all the tax benefits. So on a federal level, there's no cool tax deduction for funding a 529 plan. Now, some states will permit a state income tax deduction based on how much you put into the 529 plan, but you'll need to check with your specific state on that. All 529 plans, however, achieve tax-deferred accumulation. So back when we were talking about UTMAs and how they kick off a taxable 1099 each year, you do not get any sort of 1099s with a 529 plan. All the money that grows inside of that account grows tax-deferred. The last cool tax benefit is if you use the proceeds from a 529 plan for education, all that money comes out completely tax-free. Now, technically you could argue that the money comes out of a UTMA tax-free as well, but generally in order to get money out of a UTMA, you have to sell some securities of some kind, and that results in capital gains and interest income taxes normally. So in that sense, UTMAs would be taxable if you wanted to take the money out. But these cool tax benefits come with a cost, and the cost is illiquidity or inflexibility. Meaning, with a UTMA account, if my son who just turned 1821 wants to spend all this money on a Lamborghini, they're totally permitted to do that. There's nothing wrong with that. However, if I choose to use a 529 plan for anything other than a qualified education expense, I will pay on the federal level a 10% non-qualified distribution tax on any money that I pull out of the 529 plan that's attributable to the growth. Now, the basis, if I take that money out, just like a Roth IRA, would not be income taxable nor penalized, but the growth, that would be subject to a 10% non-qualified tax penalty. In addition, I'll pay income taxes on however much money I pulled out on the federal level. Based on your state, you might have your own state income tax ramifications, and specifically to California, I'm tracking they also levy an additional 2.5% unqualified distribution penalty tax. So generally, if we can avoid it, we don't want to use the 529 for anything other than qualified education expenses. One of the last super cool benefits of a 529 plan is the permission to do accelerated gifting. So without diving too deep into estate taxes, on a federal level, you're allowed to gift anybody you want to 18 grand a year for 2024, and that won't hurt your lifetime gifting exemption, which in 2026 moving forward is probably going to be somewhere in the ballpark of $7 million per person. If you gift more than your lifetime exemption, when you die, any assets that are in your name or in your estate will pay an estate tax on that money. Now, normally that's not something most people have a problem with because most people don't die with more than 7 million of net assets. But also the gifting exemption of 18 grand a year is pretty high, and you're most likely not going to be gifting one person more than $18,000 a year. But if you wanted to, the 529 plan will permit you to accelerate your gifting for 5 years. That means you could gift a grandkiddo or a kiddo $18,000 times 5, which is $90,000. And you still wouldn't hurt your lifetime gifting exemption. Now, if you're married, you and your spouse could gift that same level of assets, which is $90,000 per person, to one particular kiddo or grandkiddo, which is $180,000. Then, if grandma and grandpa want to be all the more generous, they can multiply that $180,000 gift times however many kids they want to set up a 5 to 9 plan for, and they can gift that much money into those 5 to 9 plans. So it's a really convenient way to accelerate the gifting of one's estate if we're trying to decrease someone's estate asset value. So now let's touch on the logistics that go into moving money from a UTMA into a 5 to 9 plan. Technically, it's not considered any sort of cool tax qualified rollover or transfer like if you're moving retirement accounts around. The reason retirement accounts achieve a rollover or transfer tax qualification is because there's no taxes that apply when you move money from one IRA to another or one 401k to another. Moving money from a UTMA to a 5 to 9, however, could come with some taxes. And then we go back to the UTMA, back to that 1099, whereby if you're going to move UTMA money into a 5 to 9 plan, you first have to liquidate the account of the UTMA, have the money all in cash, and then move that cash into the 5 to 9 plan. When it arrives, it then gets reinvested into whatever investment options the 5 to 9 has. However, by liquidating any investment assets in the UTMA, you might generate or realize all sorts of capital gains, and that will come with taxes. That means since those taxes will show up on the tax return for the kiddo, you'll probably want to make sure you knock all this out before ever applying for FAFSA, and ideally the tax year before that, because we don't want a large income tax or capital gain tax to be shown on a tax return for a kiddo, because that will show that they have income or assets, and it'll probably hurt them from an application for student aid. Now, one thing that's kind of financial planning 301, but I at least want you to be aware of, if you change the beneficiary of a 5 to 9 plan, it's not necessarily considered a taxable gift from one beneficiary to another. However, it gets a little bit tricky when you move UTMA money into a 5 to 9 plan, and then you change the beneficiary of that 5 to 9. You can see why the IRS would be sticky about this, because let's say if one kiddo has $100,000 in a UTMA, they move it into a 5 to 9 plan, and then you split that beneficiary from 100 grand to maybe 50,000, 50,000. You kind of had the first kiddo gift $50,000 of their money to their sibling. The IRS is going to get a little bit sticky on that. So general best practices, if you're going to move money from a UTMA to a 5 to 9 plan, just never plan on changing the beneficiary of that 5 to 9 plan. Otherwise, the IRS might see that as a gift or a not appropriate use of a UTMA, and you might end up in some hot water. However, if you are going to go down the route of moving UTMA to 5 to 9 and then changing the beneficiary at some point, I'd highly recommend you solicit the help of a CPA and get some clear guidance, because that's the person that's going to back you up if the IRS ever comes knocking. Now, I generally don't ever recommend clients violate tax law. However, I am not exactly sure how the IRS would also track some of these moves. If you change beneficiaries of a 5 to 9 plan in 2025, is the IRS going to know that you funded that 5 to 9 plan from an account transfer of a UTMA to 5 to 9 a decade ago? I don't really think so. However, it's been explained to me, and the advice I would give to any client is once you move UTMA to 5 to 9 money around, you just don't plan to change the beneficiary. So from a calls to action standpoint, I would rack and stack the pros and cons of having a UTMA versus 5 to 9 or both, and look to see if moving the UTMA into a 5 to 9 is in the best interest of your family. A lot of times I'm seeing this be most impactful for families who want to maintain some control over funds they provision for their kiddos, and or for those folks who are looking to achieve a bit more of a tax efficient accumulation of college expenses. Hopefully that was helpful. If you have further questions, drop them in the comments below or get in touch on the website. We'll help you get squared away. Have an awesome rest of your day. We'll talk to you later. Bye.